Stocks on Wall Street kicking off the first trading day of the new year at record levels this Thursday. Let's find out what 2020 has in store. We'll ask our guest, Phil Blancato. He's CEO of Ladenburg Thalmann Asset Management. Happy New Year and welcome back, Phil.
Thank you.
Good to have you with us again. Now, you've been cautious last year, twice when I had you mid-year and also towards the year end, saying investors might take some profits. What's your outlook for the markets going into 2020?
You know, it's funny. We had such a wonderful year last year, historic. 31% on the S&P, over 8% on the Barclays Ag. And we did it without really any earnings growth. We went through a sort of a profits recession last year, but the economy held on. So going into this year, when you look at current valuations, stocks are not cheap. But the bond market is really expensive. So first, I would say, one, you should favor stocks over bonds this year, no doubt about it. I think you need to be the idea that there's still a lot of cheap money around. You can still borrow inexpensively, you can expand, you can have CapEx, you can have M&A. And for that, we should see a little bit of earnings lift off because of a year after flat earnings, a little bit of earnings growth should help valuations come in a bit, and having that sort of mild equity market makes sense to me this year for the stock market. The bond market, I'm very concerned about. You know, you have record low interest rates. You've got free money around the world. And if you look inside the data, you're really seeing strong earnings growth in almost every sector of the labor market. People without an education, people recently out of college, people gainfully employed. We're seeing solid wage growth. And that means early stage inflation. So for that, think about a really expensive bond market that any mild hint of inflation maybe pushes the Fed back on, maybe just grinds higher on interest rates, and suddenly you could lose a bunch in fixed income real easy. So for me, equities over bonds in 2020.
So for you to sell some bonds, what would you use to have a defensive posture in case the markets tumble?
I think you just want to keep your duration short. You're not being rewarded that enough to go out to 5 years or 7 years or 10 years. You're going to pick up an extra 25, maybe 35 basis points. So rather than take that risk, if you go sub the Barclays Ag on duration, meaning sub 6 years, go down to 3 years or 4 years, you're still going to get paid around 2%. You'll give up half of 1% at the most. But in that situation where we recess or there's some extraneous event that there's a shockwave in the marketplace and you need safety insurance, then you'll be protected in those short duration bonds.
And if you're in stocks, in equities, what class would you go to? Where would you turn to?
I think it's very easy to say large cap because that's where the success has been for now over 10 years. But where you have a chance right now, I think, is go down the capital spectrum. Start to look at the mid-cap stocks whose valuations aren't as expensive as large cap. And if you think about it, you might be able to get into a SMID, you know, large, small company stocks or small mid-cap stocks. Reason why? You're getting more growth there. You're getting that consumer impact is really pretty profound there. Our healthy consumer is really going to show up in that data. So I do think you'll see some earnings growth and some CapEx in that area. And that way you can get a little alpha in your portfolio. You're still going to have a large cap bias, no doubt, but get your alpha in the mid and a little bit in small.
And lastly, Phil, can't let you go without asking, what are the risks to this scenario in 2020?
We've got some real extraneous events that could happen that would be concerning to me. One, we know about trade. Any change in the trade data, this whole idea of intellectual property and getting compliance with it, it's not going to be simple. I think we're being too Pollyanna to think it's just going to go away, and it's just not. Second, you're in an earnings recession. If we don't get earnings lift off, you know, you're not going to get growth in the market. The third one, you've got real political issues on our hands right now, whether it's the election cycle, which buys stocks are usually up in election years. That's a positive. But remember, the president was impeached by the House, and we have the Senate issue looming out there. So let's not just gloss over it. That's an issue. And then finally, economic growth. We still need to hang on there, and as of now we are. The consumer's squarely holding us up. But you got to at least hold the line at around 2% GDP to get the market going in the right direction. Otherwise, stocks are not cheap. And when they're not cheap, what do people do? Sell when things get a little bumpy. They get nervous, they start selling, and then we have a little bit of a washout.
Okay, thanks, Phil. So in a nutshell, if it's bonds, sub 60 years, and if it's stocks, mid-caps are the sweet spot.
Yes, sir, you got it.
Okay, thanks a lot, Phil.
Thank you.
Our thanks to Phil Blancato of Ladenburg Thalmann Asset Management. I'm Fred Katayama, and this is Reuters.